Ladies and gentlemen, good day and welcome to Hikal Limited Q3 FY24 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Hiramat, Managing Director from Hikal Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, good morning and a warm welcome to all of you. We extend our gratitude to all of you for participating in our Q3 and 9 months FY24 results conference call. We are delighted to provide you with an update on the progress made by our company. We trust that you have had the opportunity to review our comprehensive earnings release, investor presentation, and the financial statements for the quarter and 9 months ended December 31st, 2023. These documents can be accessed on both Hikal's official website and the stock exchange's websites. I am Samir Hiramat, Managing Director, Hikal Limited, and I will be leading the discussion and presenting the financial results. Joining me on the call, I have Anish Swadi, our Senior President, Business Transformation, Kuldeep Jain, CFO, Manoj Malhotra, our President, Pharmaceutical Business, Vimal Kulshetra, our President, Crop Protection Business, and Strategic Growth Advisors, our Investor Relations Advisors. The global chemical industry continues to witness turbulence on the back of destocking situation coupled with intense price competition, predominantly in the crop protection industry. It is further intensified with increased interest rates and a delayed recovery. We expect the demand situation to normalize towards the end of H1 FY25. The pharmaceutical industry is witnessing signs of improvement. The raw material prices have softened and stabilized, which is widely acknowledged and is aiding the sector's recovery. In this operating environment, we are focusing on enhancing operational efficiencies, optimizing costs through several business initiatives. During the quarter, our revenues stood at 448 crores, EBITDA at 65 crores with EBITDA margins at 14.5% and increase of 70 basis points on YOY basis. For 9 months, FY24, revenues stood at 1,271 crores, EBITDA stood at 173 crores with EBITDA margins at 13.6% and increase of 230 basis points on YOY basis. Also, the Board of Directors has approved an interim dividend of 30% for FY24. We expect the performance to gradually pick up and operating leverage is expected to improve. In our pharmaceuticals business, we witnessed an improvement in margin profile as well as in volumes. Efforts over the last couple of years have started yielding positive outcomes as we have started receiving regulatory approvals along with strengthening of our customer base across Japan, Latin America, and Middle East geographies in the API segment. Our new multi-purpose plant for animal health has been commissioned at Panoli, Gujarat, towards the end of Q3 FY24. In the crop protection business, inventory destocking continues to impact the overall industry. Proactive implementation of cost improvement programs has helped us in navigating industry-wide challenges and maintaining the margin profile. Recovery towards the end of H1 FY25 is expected to result in favorable operating leverage and an improved margin profile. While we acknowledge the near-term industry-wide challenges, we expect the market trajectory to improve over the next few quarters. We are well positioned across our businesses for long-term profitable and sustainable growth. Now I'd like to hand over to Manoj, who will provide an overview of the pharmaceutical division's performance. Over to you, Manoj.
Thank you, Samir, and good morning, ladies and gentlemen. We'll start with the financial performance. For Q3 FY24, pharma business reported revenue of rupees 267 crore, EBIT of rupees 18 crore, and an EBIT margin of 6.9%. For 9-month FY24, pharma business reported revenue of rupees 763 crores, EBIT of rupees 40 crores, and EBIT margin of 5.2%. On a sequential basis, there is revival in operating profits, which is up 56%. We are witnessing good traction in pharma business aided by our API business. On a YOY basis, raw material prices have softened and stabilized. This, along with the implementation of a variety of measures to enhance cost effectiveness and optimize operational procedures, has led to improved margins. On the API business vertical, we are witnessing good traction on our API business on both quarter-on-quarter and YOY basis. We continue to increase our market share in legacy product portfolio. Regulatory filings as a part of business expansion project in various geographies have started yielding results. We have a robust pipeline with 8 to 10 products under development, and we are on track with a target to launch 3 to 4 products every year. For the CDMO business, in Q3 FY24, the destocking situation continues to affect our CDMO business. We anticipate the normalization of the CDMO industry in the coming quarters. We maintain a robust pipeline of projects in the CDMO space and actively pursue additional opportunities that have arisen in recent quarters. We are in continuous discussion with our existing innovator customers and have a healthy flow of inquiries for an increased share of their business. Our 2 opportunities in phase 3 clinical trials are progressing well, and commercialization is expected in coming years. Our food ingredient CDMO business has shown increasing trends. On the overall pharma business, API business is showing good traction with deeper penetration across geographies, and regulatory approvals for new products coming through is expected to drive the growth. Improvement in operating leverage for the segment will translate to better profitability. Now I would hand over to Vimal, who will provide an overview of the crop protection division's performance.
Good morning, all the participants of this call. I will provide the overview of the crop division. For Q3 FY24, crop protection business reported revenue of 180 crore, EBIT of 22 crore, and EBIT margin of 12.1%. For 9 months FY24, crop protection business reported revenue of 508 crore, EBIT of 61 crore, and EBIT margin of 11.9%. Destocking situation coupled with intense price competition continues to impact the crop protection industry. While on sequential basis, we witnessed revenue growth while navigating through the industry headwinds on the back of improved performance in CDMO segment. There are several projects under advanced stage of discussion with existing innovator customers as well as new customers, which will drive mid to long term growth. Our cost improvement initiatives have started yielding results and contributed towards maintaining margin profile. Our new multipurpose facility at Panoli is completed and stabilization of plant is in progress. In our business vertical own products, destocking continues to impact demand across globe, and it is expected to improve towards end of H1 FY25. On the back of end user consumption trade, our medium term outlook for key products remain positive. As a part of growth strategy, we are also in the process of commissioning our new multipurpose plant at Panoli. Additionally, we are actively exploring new product opportunities to further expand our business. In our CDMO business continue to maintain a healthy pipeline of inquiries from both current and prospective clients. We continue to focus on these opportunities to strengthen our position among global innovators. This is expected to drive the growth of the segment in medium to long term. Now I would hand over to Anish for his overview on business strategy.
Thanks, Vimal. I would first like to give you an overview of the animal health business. The development of multiple APIs under a long-term agreement with our innovator animal health customer is on track. We have commissioned our new multipurpose plant for animal health in Q3 of this year. Several products are under validation. These product validation batches will be a first step towards registration and then commercialization of the portfolio. The commissioning of the new facility has enabled us to further our discussions and onboard potentially several new customers for their current and future portfolio needs. Our extensive networks and strong connections with global innovators position us as a select partner of choice in this field. By offering end-to-end support in process development and complex molecule synthesis, we have established ourselves on a solid and comparable footing. Our deep network across geographies will enable us to attract new customers and capitalize on the opportunities for a newer product portfolio, which is currently under development. In conclusion, the long-term opportunities will surely surpass the immediate short-term challenges that we see. We have embraced a new growth story during the past 2 years in order to strengthen our bold objectives. Our company's transformation Project Pinnacle, is starting to pay off as we are attracting new customers on the back of new capabilities and a differentiated technology platform. As our strategic transformation is pivoting to the next phase, we have taken strides towards integrating sustainable practices as part of our ESG initiative in line with our common goal of enhancing people's lives and helping the community. We reiterate our commitment towards ESG as a fundamental driver of our business. Now, I would like to open the floor to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Aditi from ADM Advisor. Please go ahead.
Yeah, hi. Thank you so much for the opportunity. Just have a couple of questions. First is, you have recently signed an MOU with Gujarat government for investment of close to 500 crores. So is this a new capex that we have planned, or can you share some more details on the same?
Yeah, thanks for that. So the MOU that was signed is for the capex that is currently underway in our Panoli sites for our new plants, which will be completed in the next few quarters. So this is already being capex that we've already committed and which we have started, which we are spending from the last couple of years on the site. It's part of the original capex. Yeah.
Okay, got it. And the second question, sir, that given the challenges in the agrochemical industry is facing, I just wanted to know your long-term view on the industry.
Well, I think medium to long-term fundamentals are still very much intact. I think consumption has not gone down much. It's just a massive destocking of the inventory that has taken place post-COVID, where there was a lot of overbuying and the channels inventories was flooded. But we're seeing that reducing. Some markets have already come to acceptable levels. Others will follow the next few quarters. And so we see the fundamentals are still intact. The hypothesis doesn't change for growth potential.
Okay, got it, sir. Thank you so much, and all the best for the upcoming quarters.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and one to ask question. Our next question is from the line of Rajay Shah from HR Securities. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah. Good morning, sir.
Good morning.
I have a couple of questions regarding our pharma business. So, just wanted to understand, in our pharma business, what is the scenario like, especially in terms of competition from China? And how is it panning out? And as an industry, how are the pharma majors dealing with it and subsequent impact on us?
Sure. You had one more question. You want to ask that as well? We can answer them together.
Yeah. Also, some highlight on the progress on our pharma CDMO business. What's going on? What efforts we are making? What are our future plans?
Wait, Manoj, you want to answer this, please?
Yes. So as you know that we operate in two segments. One is the API segment, which is our own product and own development, and other is in the CDMO side. So the competition from China remains in the API segment, and we have to be cost competitive, and that's what we always do. We benchmark our cost position first of all with Indian competitors and also competitors from China. So that continues at the same level. There's no real increase or decrease in intensity of that competition. Number two, on the CDMO side, it is that China plus one factor is definitely playing. All the CDMO or innovator customers want to de-risk from China, and they are looking at India and Hikal as with more and more new opportunities, which is under progress. And that's why we are quite bullish on our CDMO term business. Yes, in the short term, there have been challenges because of inventory destocking and taking some time for new opportunities to go to commercial scale. But we are confident that in our API business, we will remain to be competitive in all our product portfolio which we launch. And on the CDMO business, we see long-term traction definitely coming our way.
Okay. Just one more question regarding API business. How are our raw material prices trending out? Like, since I believe that last couple of quarters they have been falling, and what do you see like the prices going forward?
So they have been falling. Yes, you're right. Raw material prices have been falling, and in our opinion, it has reached a bottom trend. And at least till first half of 2024, calendar year first half, they will remain at this bottom level. Going forward, we have to really wait and watch, but yes, they have bottomed out at this stage.
Okay. Regarding like what are our like top API products that we are selling? Can you name few and what contribution to our revenue what contributes it to our revenue? Can you share that?
We don't provide product-wise information in this forum, but yes, the old legacy products, if you see from our name filings, you would definitely find them there, but we really don't disclose product-wise revenues.
Okay. No issue. Thank you, sir. That helps.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask question. Our next question is from the line of Ravi Shah from Opal Securities. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes.
Yeah. Thanks for the opportunity. I just have one question on the animal health business. So we had mentioned that we are in discussions with several customers to provide manufacturing and R&D solutions to them. So what is our progress over there? If you can give some information on that.
Anish, why don't you take this? Yeah?
Sure. So as you know, I mean, discussions start at the early stage, especially with new customers. So first we offer them or we give them an overview of what we can provide. Everybody is very interested to understand what our capability and our technology toolbox is. And we start at the early stage, which is the R&D pipeline stage, and then we progress to the commercial manufacturing. So we've had keen interest from a select group of companies or global innovators who are in discussions at various phases with us.
Understood, sir. Thank you. So I have one more question if I could squeeze it. So what is the capex you have incurred during the 9 months ended, and what is the end year target for capex?
Kuldeep, CFO, can you take
Yeah. As we mentioned in earlier calls, our target is to spend 200 crore each this year. So far, we have done almost 170 crore, and the balance we'll do in the next quarter.
Understood, sir. Thank you, and all the best.
Thanks.
Thank you. Our next line is from the line of Ankit from Bamboo. Please go ahead.
Yeah, thanks for the opportunity. My question is on the animal health contract that we have signed. So the ramp up for this project is expected from FY25 or from the Q1 of FY25, or how do we see the ramp up for this project?
So currently we are in the validation phase of the portfolio that we're doing. So we've completed a few products, the development of a few products. The validation will be ongoing for the next 12 to 14 months, and then post which we'll get into commercialization. There'll be a little area of where the plant will lie idle for some period of time while the registrations are being taken up by the customer.
Sure. So these are for products which are actually going to be commercialized. They're not already commercialized. Is it like that?
Yeah, they're being validated right now. So we supply the validation batches. The customer uses them in their formulations to register the products, and once they get the registration, we supply them commercially. These are new developments.
Okay. So these are already launched patented products, or they will be launched over the next year or two?
It's a portfolio of a mix of products, yeah.
Sure, sure. So you expect the significant ramp up for this segment happening only from FY26?
Yeah, that's correct. Yeah.
Okay. And, like how much revenue can this segment contribute, let's say in FY26, 27, in an overall scheme of things?
Yeah, so we already have a small or an inroad into the animal health business that's existing. But as we see the potential, if I look out maybe 3-4 years out from today, we could see a potential of anywhere between 200 to 300 odd crores of potential revenue.
Okay, and this will be largely driven by this contract which we have with the innovator?
It's a mix. It's not only this contract. We have inroads into other customers as well. So it'll be a mix. I'm just talking from the entire animal health business perspective.
Segment perspective. Okay. And on the API side, if you can give an outlook, when do you expect things to stabilize and revenues scaling up and margin and profitability coming back for us, like from which quarter, or if not this year, then next year, like from which quarter do you expect things to stabilize for us?
Manoj?
Yeah. So on the pharma APIs, the volumes have recovered. The margins have also recovered, and they're getting back to what we were 2 years ago. The overall pharma business is subdued because the volume offtake in the CDMO segment has been subdued in the last 2-3 quarters. But I'm sure that in the next year, second half, both API and CDMO business will be back to historical levels of margins.
Okay, but we can understand pressure on the generic API side, but do you think, but are you also seeing pressure on the CDMO products as well?
CDMO products are more under pressure because of inventory correction. They're long-term contracts. The margins are fairly stable. So once this volumes recover, you will be back on track on our historical margins on CDMO business.
Sure. One longer-term question, if you can talk about, from Hikal perspective, we have done a lot of capex over the past 3-4 years, and we have entered into, or we have, grown our animal health business as well. And, we have been facing challenges over the past 2 years almost. So let's say when situation normalizes, if not, first half of next year or by at least, second half of next year, do you think, we can grow our business by 20-25% given the amount of capex we have done, and our margins can inch upwards of 19-20% that we had reported 2-3 years back, and we were hoping for an increase from that range?
Yeah, I think I'll take that. Yeah, you're right. I mean, capex, we have done capex in the last 2-3 years. It is all panning out as we expected, except for the current 1 year of this crop protection impact. It will come back, I think, and then we will start seeing this growth, historical growth. We will come back to the double-digit growth levels, which we expect to happen, and this will automatically give us operating leverage. And once you get operating leverage, you will see our profitability go up significantly from where we are today.
Okay, so we had almost, we were almost touching, or in FY23, we touched across 2,000 crores kind of revenue. And most of the capex which we had done was yet to be capitalized or yet to be put in use. So, and given the capex that we have done, do you think in 26, 27, we can look at, 3,000, 3,200 crore kind of revenue if things come back to normalization and our margins inching up of 20%?
I mean, that the plan is to grow the margins in this range what you're talking, and to come in this level of revenue growth as well. But I think we're looking more on margins rather than revenue, but revenue will also grow. You're right. I mean, 2,000 plus capex will give us a significant uptick. It's going to take us little bit of time because of the current scenario, I think. But if you look at 27, 28, I think we should be back to those kind of numbers which you're talking about here.
Okay. Thanks, Mr.
Thanks.
Thank you. Our next question is from the line of Rohit from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on sequential recovery in terms of margins and overall operating performance. So first question is on the business segments. So in terms of pharmaceuticals as well as for crop protection, now since we are having dialogues with our customers, what is the feedback in terms of the inventory situation and normalization of business? I mean, what are their expectations when things will start normalizing and a steady state growth will commence? So any feedback on that?
Well, I think the pharma side, as Manoj mentioned, we expect 1 or 2 quarters things will come back. Crop, the estimates are second half of FY25. I mean this calendar year. But crop is undergoing massive stress, as we know. It's either going to be Q3 or Q4 of the year. That's anyone's guess. Currently, we're estimating from Q3 next financial year, things from the crop side should start coming back. Pharma will be slightly earlier than that. And I think by second half of the year, I think, as Manoj and Vimal mentioned, should be back to, pre to COVID type of levels. We should be back.
Sure. And just an additional clarification in terms of EBIT margins, what would be a steady state margin range? I mean, I don't want any particular number, but for both the segments, once things come back to normalcy, what are the kind of steady state margin range that we are looking at? Thank you.
Well, I think the previous investor asked a question about what kind of EBITDA margins we'll be looking at medium term. I think if you get to that kind of level, automatically EBIT will go up quite substantially from where we are today to what we were about 2 years ago. So we should get back to those levels.
Fair enough. Second question to Anish sir on the animal health business. So just a couple of clarifications here. So you mentioned that probably during the validation phase, the plant will be idle for a period of maybe few quarters. Is it that we will not be able to manufacture any other products for any other customers during this time?
Yeah. So the validation that's happening, we have a portfolio of products. So when we develop the products, we're developing 2 to 3 products at a time, right? And then we concurrently validate that. So there will be a lag. It won't be a few quarters, but it'll be a short lag in between where the first product that's been validated, supported, and supplied to the customer will then come back from registration, and then it'll concurrently happen. So it's not happening all together at one time where there's a large lag and then the commercialization starts. It starts concurrently. And we also have backup plans in terms of what we can do in the asset as well. We have some other products that we are seeing how best it can fit into the asset where we can monetize the sale of the products.
Sure. And just one more clarification on this in terms of margin profile. So once this business reaches a particular scale, will it also have our company-wide margins, or will it be better margins given that at least in the earlier part of the composition would be more pronounced towards the patented or products which are particularly manufactured for the specific customer? Thank you.
Yeah, so I think first once we start out, it's a business build, right? So it's a business that we've got an anchor customer, we have other customers in the pipeline, we have other products that we're looking at. So in the initial stages, the margin will creep up to where the company margin is once it stabilizes, right? And that we've already discussed from about 2 years ago. Once we get the operating leverage and our business improves, then the potential for the margin to expand is considerable over the next 3 to 4 years, certainly.
Sure. And just apologies for squeezing in a last one. So about the waste disposal issue that had cropped up a couple of years back, where are we currently? It is completely resolved, and whether the fine or anything penal action that has been taken care of?
No, the matter is sub judice, and there is no update right now. There is a stay in the courts.
Sure. No worries. Thanks a lot for answering all the questions and best of luck, sir. Thank you.
Thank you. Our next question is from the line of Ankur from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. First question on the CDMO business, both in the pharma as well as the crop protection side. How has been the share of generic versus patented, and if at all there has been any shift over the last, let's say, couple of years?
Sorry, the question is the CDMO generic versus patented. Is that the question?
Yeah.
Yeah. So it's our CDMO business. If you look at the crop side, it is mostly patented products on the crop side. We have a few generic products which are CDMO, but they're again exclusive. As you know, in the crop industry, there's something called patented, there's something called proprietary generics, and then there's plain vanilla generics. We are not in the plain vanilla generics in the CDMO space at all. We're either in the patented predominantly or in the proprietary generics where the customer has patents on the formulation technology and they have high market share in those generics. So that's how the crop industry is. On the pharma side, the CDMO business also is a mix of generics and proprietary generics again and on patent. We are not into plain vanilla generics. We have a few life cycle management products, but if you look at it predominant as a company, it is patented and proprietary generics.
Sure. And over the last couple of years, is there any change in the mix here? Maybe you got more products on the generic patented molecules or the proprietary
I think
side?
we're getting more on products on the patented side, which is a good sign. Customers are trusting us with IP, with technology, our capabilities, our track record. So we are winning the new RFPs that we're winning, and Manoj spoke about a couple of phase 3 clinical trial molecules, and that's happening. And we're also moving up the value chain from being intermediate suppliers, like getting opportunities to make APIs now for also NCEs. So, there's a big change in the way customers are looking at us and giving us high priority projects. We are getting those, and we're winning those,
Sure. And the margin profile on, these products, how is the RM inflation, et cetera? What sort of, not exactly a number, but what sort of range of margin that we are working on? Is this a rupees per kg margin fix that we earn, or there is a percentage margin and probably RM inflation is a pass-through here?
Yeah, it's a fixed margin and RM is pass-through, but the margins are significantly higher than the current company margins, on the CDMO. Because it's on patent.
So when you say fixed, sorry, it's rupees per kg or percentage?
Sorry, it is percentage, but the RM is pass-through.
Okay.
But it's enough. The RM is a small part of the total cost because it's on patent, so margins are pretty high.
I'm presuming the same applies for both crop as well as the pharma side.
That's correct.
Great. Secondly, from a product approval timelines perspective, you did mention in your initial remarks there are many products in the pipeline. At what stage we are, and if you can share the number of products and probably timeline when we can see some ramp up, some approvals there.
See, we expect market to recover from second half of FY25. So gradually, we see a recovery in a couple of quarters. And
sir, this comment will be true for the existing CDMO revenue that we have. Is that right?
Yeah.
Or the newer ones, which are so the newer ones are also the product approval, etc. is done, and the ramp up will happen once the market opens up.
Yeah. So we have currently 3-4 CDMO products under development, but that also ramp up will happen in second half of next financial year.
Sure. And on the pharma side?
Manoj?
Pharma side, yes, it is similar only, and once we improve the volumes, margin will also improve. And it's a mix of, as Samir mentioned, patented and proprietary generics.
Okay. Given the fire incident and that matter being still sub judice, is there any, whenever you're going for new business win and, client interaction with clients or maybe existing clients or the newer ones, is there any concern on that side, or, how has been the market response to that?
Sorry, what incident? Fire incident?
Yeah.
No, there was which fire? There was incident in Surat in January 22.
Yeah.
That's the one, right?
Yeah, that's one.
Yeah, that's not a fire incident. That's an external incident. It's nothing to do with the factory. So that incident has been explained to our customers. In fact, customers post that have reiterated the commitment to Hikal. We've won new customers. We've onboarded new customers post that incident. Because clearly the judgments from the courts are in our favor, and we've got favorable rulings. That was not our material, not our tanker, and this is all in the public domain. I mean, we've given an update in multiple quarters, and there's been no impact on our pharma or our crop business. And customers trust us, and they've done their whole due diligence, and they've checked us out. They've de-audited all our facilities, and we've been requalified as a long-term sustainable partner for them.
Great, sir. And just last question, if I may. From our exports share perspective, we have been there across US, Europe, Southeast Asia, and the inventory issues that we are seeing in. Is there any specific geography which is more impacted or less impacted, and we are seeing some early signs of improvement, if at all?
No, I think, companies buy central procurement, right? Then they decide which markets they sell. These are the big innovator companies or the big, which is where we supply in, where our generic presence is smaller. But even then, our pharma API goes into US and Europe mostly, while the crop business goes into global markets. Globally.
In all.
So there is a global inventory correction happening. I think some maybe little percentage here and there, but it's not significantly different from the geography.
Yeah.
Okay. Great. That's it from my side. Thank you and all the best.
Thank you. Our next question is from the line of Ankit Pandya from InCred Asset Management. Please go ahead.
Yeah, hi. Thank you for giving me the opportunity. So, 2-3 questions from my side. So, firstly, on the volume side, how has been the growth of volume for both the crop and pharma on a sequential basis for the quarter?
Well, volumes for the company were down by 9% compared to the YOY basis. Quarter-on-quarter basis, volumes for the company were down by about 6%. For the crop business, volumes were down by 10%, and for pharma, they were down by 2% on a quarter-on-quarter basis.
Pharma was 5%?
2%.
2%. Okay.
10%, yeah.
So, and secondly, on the other expense side, so...
It's not a right indicator of the business because we have a diverse product portfolio. Some are very large volume, low price products. Some are low volume, high price products. So just this number doesn't give you the correct idea of how the business is performing. Yeah.
Okay. Fair enough, sir. So, secondly, on other expenses, so sequentially, there's been almost 12 to 13% increase in other expenses. So, can that be mainly the other expenses have increased due to the commissioning of the new facility also? And how should we see, on the quarterly run rate, the current quarter, if we can take that as a steady state number? Will that be a fair assumption?
Kuldeep, why don't you take it?
Yeah, sure. Yes, you are right. The other expenditure are going up because we have created 2 big facilities which will be ramping up in the coming quarters in the future. So we have already created the infrastructure for these 2 facilities. And definitely, currently, it is impacting our P&L. But going forward, we will have the contribution, the margin coming up from the new businesses, and it will neutralize the impact of this cost. So it's a front loading of the cost.
Okay. Exactly my question that, given that the new facility is commissioned, so in the coming quarter also, will we see further bump up in the other expenses, or will the current quarter we can assume the steady state number for going forward?
Maybe, some inflation index may really have some impact. Otherwise, will be it's in the same range.
Okay, fair. And lastly, on the CDMO API split, so on the company level, not the crop protection or pharma, but on the whole company level, what is the current CDMO and API split for the company?
For the company, CDMO is over 50%. It's yeah.
Okay. And so, do we can we expect any change in this contribution to CDMO going for higher share in the next 3 to 4 years, given that the new capabilities that we have set up and the new CapEx that we have done? So in the next 3-4 years, do we expect the CDMO part to drive growth, or this split will continue even in the long term also?
No, I think the focus is to grow our CDMO business significantly. That's why the new assets that we've created in pharma, in animal, and on the crop are going to attract new CDMO customers and new projects. And a lot of the R&D projects that we're doing in R&D files also in the CDMO space. So you will see the percentage increasing of the CDMO split in the company. It will go significantly higher in the next 3 to 4 years.
Okay. Any ballpark, broad range, if you can give, 70% plus or 60 to 75% range or something, directionally, if you can, aspirationally, what you want to achieve in the CDMO space. So mainly I'm asking from the point of view that, given that we are more on the patented and the proprietary side in the CDMO space. So given that in that business, the margins are upwards of 25%. So and even you have been guiding that we want to achieve 23-25% EBITDA margin over the next 3 to 4 years. So, given if the CDMO split, CDMO pie is much significant, so the margin probably that ramp up will also be much faster. So, from that point of view, I'm asking directionally for the contribution of CDMO.
We're currently at about 50-odd%. The target is to grow up quite a lot over that. But we always look at the best margin profile of the products. Because generics also, we are also picking some products in generics where we see very good margins. If you have some niche products on the generic side. So it's always a discussion. Yes, the focus is to do more CDMO, more on-patent stuff where the margins are pretty nice. But we will not disregard the API opportunities also, which you could also get some unique opportunities there and some significant margins in some products. So the case to case, but the general trend is to attract more CDMO businesses, more long-term, more sticky, and it gives us a good traction with our global customers.
Fair enough. Lastly, just on the pharma industry in the CDMO space, given that there's been a lot of funding challenges that have been going on in the industry. So most of the innovator companies also. They have been rationalizing some of the molecules which are probably in the phase 1 or phase 2 and where the clinical data is not so strong for them. So they are rationalizing those kind of projects. So have we seen any challenge on that front, or that has been relatively stable for us?
We are not involved in the very early stage development on the pharma side. We typically get involved in phase 2 and later. So, the early lead drop-off areas where we're not participating in right now. We get involved in process development and, delivering of material, typically which is post-phase 2. So the chances of the product going across are much higher than if you can get involved very early on in the development.
Okay. So that risk is relatively less for Hikal.
There is obviously some drop-offs which will happen, but it's significantly less than getting involved in a lead or a phase 1 molecule.
Yeah. Okay. And so just I have to ask for your view on this whole funding challenge and how it is currently, and by when do you see it stabilizing going forward?
Sorry, I couldn't hear that. Can you repeat the question, please?
So I'm just asking for from your view on the whole funding challenge in the pharma space that has been going on in the CDMO. So what is your view, and how is that panning out in the last 1-2 months?
Yeah, that question is more on funding for phase 1, phase 2 kind of molecules. Yes, there has been a slowdown, and especially the smaller biotechs and emerging pharma in various geographies, mostly in America and Europe. There have been slowdown, but as Samir mentioned, we are not really in that space. When phase 2, phase 3 of bigger customers, so we have not faced this challenge of funding may be drawn on early stage molecules.
Okay, fair enough. Thank you, and best of luck, sir. That's it from my side.
Thank you. Our next question is from the line of Amar from Lucky Investment. Please go ahead.
Hello?
Yes, sir.
Yeah. So, sir, just to understand, you indicated that by second half, we expect the pickup in revenue. So, and you indicated that it would be a pre-COVID level kind of revenue. So I'm just able to, I was not able to understand that. What we are indicating in that?
No. The question was, when will margins come back to the old steady state? So that was the question by one of the investors.
Okay.
So I said, H2 onwards, we expect revenues and margins to come back to where we were kind of 2 years ago.
Okay. And primarily, sir, at what utilization we would be working at this point of time?
Well, the pharma plants are running at close to 75 to 80% utilization, 70 to 80%. Crop is a bit lower because of the current destocking, and it will improve the next coming few quarters.
And if I see your CWIP currently, so around about 500 crores of CWIP, and are you saying this will further increase because you have a plan to invest another 200 crores? So approximately total 700 crores of capex we are doing in next 2 years?
No. As we mentioned earlier also, the plan for the capex expenditure for this year is 200 crore, out of which we have already done 170 crore, which is part of the CWIP, which is currently sitting in the books.
Correct.
So for the next quarter, we are expecting 30-40 crore more to spend on the capex.
I got that. And what would be your capex in FY25 then?
Again, we are working on it. We'll have to really see but typically we are doing almost 150 to 200 crore each year.
Okay. And when this, sir, 500 crore will get capitalized?
See, as Vimal and Samir has mentioned, the big plant at the location is under commissioning. Let's see, once it is finished, probably, this quarter or the next quarter.
Okay, so at least by second quarter we will see this 500 crore getting operational.
Definitely.
And this would be largely what, agro or pharma, or how the split between this 500 crore?
It largely is a crop protection, one of the multi-purpose plant, which will give us a lot of value addition next year.
Okay, and part of that would be backward integration, right?
Yeah.
So this 500 crore is not fully the revenue facing capex, right?
It includes infrastructure as well.
Yes.
So out of that, sir, what kind of asset turn we can see from this 500 crore?
I think we are at expecting 1.1.
1.1 times. But the margin would be better than the normalized margin of your current company average?
Definitely margins are better, but if you look at the current global scenario, we have to really first come out of it, then we will really gradually improve our margins.
I agree. I'm saying at the normalized level, considering everything is normal.
Definitely, yes.
Okay. So it would be like what? Normally you make 18% average, so 18 to 19% average. So this would be what, at least 300, 400 points better?
Little better.
Yeah. Sure, sir. Sure. Perfect. Thank you. Thanks a lot for the opportunity.
Thank you. Our next question is from the line of Rohit from Centrum Broking. Please go ahead.
Yeah, thanks for the follow-up. Sir, in terms of R&D capabilities, how have those improved in the last maybe 3 to 5 years? And an allied question to that, maybe pre-COVID, how many customers we had in CDMO for both crop protection as well as pharma, and how it has changed now in terms of the number of customers we have acquired, based on the capabilities improvement? Thank you.
Well, number of customers are pretty significantly increased. That's multifold in the last 4-5 years, I would say. There's been a lot of push on, business development and onboarding new customers and building new capabilities. So I don't have the exact number, but it's gone up significantly in the last 4 to 5 years. The R&D capabilities, that question that you asked was, there's a lot of emphasis on getting into complex molecules. Customers now come to us for difficult to do technology and multi-step synthesis, and where it is, where we have something unique to offer from a technology perspective, scalability perspective, and we're able to manufacture at different scales, meeting very stringent quality requirements is also what we're seeing from customers, impurity profiles, quality requirements, special particle sizes that they come to us for. So the type of projects that we're doing are not plain vanilla projects anymore. The shift is beginning to get more complex projects, and customers are looking at Hikal for complex molecules. That's been the shift, I think, in the last 4-5 years.
Sure. And just one allied question. So, effectively, these complex chemistries would also attract better margins. So, incrementally, whatever projects that we are working in should entail higher margins. And once the business environment normalizes, maybe after FY26, 27, we should see a continuous improvement on the operating margins that we had been, envisaging earlier, that 18 to 20%, and then there could be some improvement on a yearly basis. Would that be a right assessment?
Yeah, absolutely right. Yeah. First, I think operating leverage itself will improve our margins from where we are today. Currently, the plants are not fully utilized because of the global macro crisis taking place. Once we get that back into steady state, then already operating leverage will help improve our margins. And the new products that come into fold in the next 3 to 4 years will have a better margin profile. So the blended margin will be higher than the historical margins. On a stepwise basis, we're moving towards that, yeah.
Fair enough, sir. Thank you. And best of luck.
Thank you. Our next question is from the line of Ankit from Bamboo. Please go ahead.
Thanks for the follow-up. So my question was on the asset turn query that the previous participant had asked. So, our asset turns, when in earlier calls we used to say that our asset turns will be around 1.7, 1.8 times, then it reduced to 1.5 times. Now you're talking about even 1.1 times for the new CapEx that we are coming up. At 1.1 times, even with 18-20% margin, our ROC will be less than 15-16% as well. So any views on this?
I think that I think we spoke about a 1.5 type of asset turns.
Yeah,
and that is from the revenue generating capex. This 1.1 is a blended asset turn because our infrastructure capex is part of it. That's what we mean by 1.1.
Okay, but these are all brownfield capex, right? So
no, but we are building very large plants. So for example, animal health plant is more of, even though it's on an existing site, the entire infrastructure is dedicated to this. There are a lot of, and these plants that we built are pretty large. So a lot of expansion has to take place in infrastructure also to support these plants. In the next phase of capex, we will have less infrastructure requirements, and those capexes will be largely revenue generating capex, larger percentage than where we are today.
Okay. 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 Thank you. Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Samir Himmat for closing comments.
Thank you, everyone, for joining our quarterly earnings call and for your continuous interest in our company. We appreciate your support as we navigate through the challenges of the global business environment. As we conclude this call, we want to assure you that we are here to address any further questions or concerns. Please feel free to reach out to us or our investor relations partner, Strategic Growth Advisors. Once again, thank you for your participation and have a good day. Goodbye.
Thank you. On behalf of Hikal Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.